Whether it's the stock market or the bond market or capital investing, it seems that there's only one answer to just about every question these days: artificial intelligence. Blair Effron of Centerview Partners spends his time advising corporate CEOs on deals and investing, going well beyond AI. We asked him, just how is the rush to AI distorting the rest of corporate finance? Blair, you spend a lot of time with big corporations and their CEOs. All the talk right now seems to be about artificial intelligence. How much is that distorting what's going on in the C-suite?
First of all, thanks for having me. David, I think it's distorting the markets much more than it is the C-suite. Okay, obviously the markets are all about AI, $700 billion worth of investment. At some point, investors will demand a return. And if you're worth $1 trillion and you trade at 30 times, that's $35 billion in net income you need. You pick the company that has that profile. Every time this happened before, the markets will get to the right place. There will be dislocation. Whether dislocation is upheaval or not, I don't know. What I do know is that CEOs are absolutely tuned to this. They are better at managing through these kinds of issues more than ever. And they look at AI from a business perspective as important. You would argue that AI investment is adding 30 basis points to 50 basis points of GDP growth, and it's helping companies. Now, it's not helping companies quite as deeply or broadly as people think. It takes a long time for a company to figure out how to use it as an appropriate tool. So I'm not one who thinks from a business perspective there's going to be a big cliff on employment. But it is on everybody's mind. The bigger question is the economy, and that's what CEOs always think about. And I think for the past 5 years or so, since COVID, most CEOs, if you talk to them in January about the year ahead, were always more optimistic than CBO would have been, IMF, Bloomberg, and they'd be right. I think that has shifted a bit most recently, and I think there's a level of caution that I haven't seen so much before. And I think most CEOs today think the economy is a 1.5% economy. They would have thought it was a 2 to 2.5% economy early in the year.
What has shifted? I mean, is that what they're seeing in their own numbers internally or more broadly?
Seeing in their own numbers. And you're seeing in some of the earnings that have been coming out. What shifted is the consumer. It is finally, I think, catching up with the consumer confidence index, that Michigan index that comes out every month, which is at all-time lows. The consumer was still spending. Now you have consumers really having gone through their savings built up when they weren't spending money during COVID, and becoming much more cautious. So I think how that settles out, I think, will be incredibly telling. And you combine that with energy price, and from my perspective, it's energy price as inputs for most of the products that a lot of our most important companies are using. And you can see where there's a bit of turbulence. All that said, turbulence that will be managed, and I do believe the economy remains incredibly resilient for all the reasons everybody's thought over the past several years. And I think that, when all said and done, will win the day.
Perhaps the most important job of a CEO is allocation of capital. And as the CEO looks at allocation of capital, put aside from the hyperscalers, they're in a different category. There is some hydraulic pressure to invest in AI for just about every company I can identify. How do they do enough so they don't get left behind without going too far and having something that, as you suggest, doesn't have the return that they need?
So first of all, it's a big difference if you have 5 companies spending $700 billion, 5 companies whose market cap together equals the GDP of China, second biggest country in the world, right? Most companies in the S&P 100 are making, and actually even more broadly, are making appropriate investments in AI. They're spending more than they thought they would, but it's being implemented on a much slower basis. I think if you are not tech native, you're not yet using AI anywhere close to its full potential. That moderates how they make capital investment decisions. They know this, okay? So I think that if you look at the typical consumer company, they use AI exquisitely, but they're spending $1 billion, $3 billion, and $5 billion in capital. I'm talking about the biggest companies, the S&P 100, which is manageable. The bigger question is going to be, when can they actually become effective enough to realize the promise of AI from where we are today, I don't see that.
In order to be able to make the capital investments, these companies have to come up with the cash, these hyperscalers. That has resulted in a lot of issuance, debt issuance and equity issuance. It's really record. We see it in the bank results right now, all the issuance going on. Is that crowding out at all what the corporations, other than the hyperscalers, can do?
Not yet. It is. There's a ton of liquidity. I am surprised that investors, particularly on the debt side, have been oversubscribing by multiples and willing to put money to work. The question of capital generally, I'd say one, very liquid, two, at cost, which is the key thing, that is still relative to where Fed funds are, I'd say reasonable. As soon as there is a turn in the hyperscalers, I think we'll have a very different conversation.
Centerview is global, it's not just US. One of the themes that we've seen with respect to tech, more generally, and certainly AI, is Europe versus the United States. Europe, perception has been left behind. We had the Draghi report, there are various initiatives going on. Are you seeing from your work evidence that Europe is in the move to catch up or at least get closer?
I do, but you use the word perception. It's a reality. The fact of the matter is 43 of the largest 50 companies in AI are US based. Europe has one. Let's just talk about the market cap. They have one company, ASML, worth $800 billion. The next company is $350 billion. That is less than 10% the size of NVIDIA. They are, I don't believe, in a position to catch up. You look at the economies of a Germany, of a France, flat. You look at the interest cost of a UK, too high. And the lack of coordination, I think, is a big issue. The fact is, the regulatory environment there, they're trying to do just what you said, the merger and acquisition environment, the rules are changing. They want to have more broad discussion as the regulator as to what's an issue, what's not, give them obviously some leeway there. And they look at the question of what is an acceptable merger or not with a much different lens, okay? It hasn't changed, the numbers at all. M&A is 50% of the M&A market in the past 6 months has been US driven, same level it was last year. So I think it's a long time before Europe realizes the promise of what they want to achieve.
Is it an even bigger problem for Europe not having a unified capital market? I mean, that's one advantage the United States has. It's one capital market. Over there, they have not been able to pull it together.
Not only do they not have one capital market, they don't have one view as to what kind of GDP growth and what kind of debt to GDP you have to subscribe to. There's exceptions every year. Italy makes the exception. Spain makes the exception. So they spend more time, I think, with, call it intra-family, back and forth, than they do focusing on the right thing. And I do think, as a place for intellectual capital, incredible. They don't let that intellectual capital be unharnessed in a way that the U.S. markets do.
One area of deal-making where Effron and his Centerview partners have been particularly active over the years is media, including as an advisor to both Paramount and Disney. One area, particularly in the United States, we've seen a lot of deals announced, at least, is something you know terribly well, which is media.
I do know a little bit about it.
with a combination of Fox and Roku going one way, I would say, toward integration, and on the other hand, you have Comcast spinning off NBCU going, it appears, the other way, separating distribution from content. Where are we headed here? Why is this all happening right now?
So first of all, it's happening because people are realizing that scale really matters in that sector. Why does it matter in that industry? Because they're fundamentally becoming technology companies. The technology companies are coming in, they've been in, whether it's an Apple, whether it's a Google, whether it's Amazon, and they're highly effective. So there has been, there were too many small companies. There are too many companies doing streaming, keeping down the margin. In fact, there was only 2 companies that showed double-digit margin. Netflix, 30%, Disney at 12%, and then everybody falls off a cliff. So what Comcast did is actually in line with that trend, because by separating a very mature distribution business from a vibrant content business, they will have more choice. I think in the case of News Corp, Fox, they recognize without some sort of way to reach consumers through streaming, they'd have a lot of problem. So I think they're making the right moves, but that's what's driving some of this consolidation. I will tell you, I think there is a highlighted concern, which has not been justified yet, that that AI is going to have a dramatic impact on employment levels. I see quite the opposite. And when you look at what happened with CGI, it opened the way for more employment. If I look at the question of AI and you're doing an animated film and you're spending $200 million to put it out, 500 million total, and you have 500 people working on it, and it takes 2 years. Now you bring AI, and it's 50 million to produce. It's 6 months to make, and it's with 50 people. You have just freed up a whole host of really smart, really creative people to increase content availability. And if you talk to the CEO of any of these companies, that's what you're hearing.
Does tech win? And by that I mean, if you look at the landscape right now, just in terms of amount of time spent viewing on screens, YouTube is just running away with it. Fast Netflix, they're just running away.
Absolutely phenomenal company.
It's a better mousetrap. In the end, do the tech companies win? And that doesn't necessarily mean buying the studios. You might not want to buy the studios, but they basically get to dictate the terms.
So I wouldn't say they win. I would say that if a content company doesn't become really tech native, they'd have a problem. I will also tell you, if you're a tech company, you don't actually understand quality content yet. Okay, you don't understand quality creativity. They know it. So the key for who is going to win is the company that can combine content with technology. If you look at what Disney's doing, making progress in that direction. If you look at what David Ellison is trying to do with Paramount, I say trying because we're not closed yet, it's all about the marriage of technology and content. So I think those companies actually are better positioned to get the two together than some of the bigger companies that don't have that creative DNA in their system, but they certainly know how to get out product and distribution.